Most people tell you that trading options is way too risky for the retail trader. Well, that's just garbage. Hello again, this is your Minister of Capitalism, Brett Davison. And today, I'm going to dive into the question, is trading options risky for a retail investor? Trading options is like everything else in life. There are risks involved, and you need to educate yourself before you get started. There's simply no way around that. Options trading can be a risky but lucrative game. Options trading is not inherently risky. Like any other financial investment, it can be a great way to make money, or it can be a terrible decision and cost you money. Options may also seem risky because the margin requirements are high and the brokers who offer them don't explain it all that well, at least when compared to stocks on straightforward commission fees, i.e. buy and sell. But remember that with stock investing, brokers require no margin at all. So in reality, options have much more conservative risk-return ratios than stocks do. In order to assess the risk profile, you first have to understand what is involved in trading options. There are two different types of risk involved, riders and holders. The holder is in less danger than the rider. If you buy or hold an option, then your downside potential is limited to what you paid for it. So if you buy a call, you're buying the right to buy a stock at a certain price, the strike price. If you buy a put, you're buying the right to sell a stock at a certain price. So if you buy a call, you want the price of the stock to move above the strike price you bought it at, and if you bought a put, you want the price of the stock to fall below the strike you bought it at. Instead of buying, you can also sell or write options. In this case, you would sell calls or puts and would receive premium in your account for doing this. If you sold puts, you want the price of the stock to remain above the strike price you sold it at. If it falls below the strike, then you will have to pay the difference between the strike price and the current value of the stock. You would still get to keep the premium you originally collected, which would help offset the loss. If you sold calls, everything would be the same as if you sold puts, except you would want the price of the stock to remain below the strike you sold it at. By writing calls or puts, your potential gain is limited to the premium collected, but your risk is almost unlimited. So as you can see, there can be a lot of risk involved, especially when selling or writing options. And if you don't know what you're doing, and you go along with the idea that you make more money selling options rather than buying them, you can end up in a lot of trouble. Which is why we focus on buying calls and puts inside the Empirical Collective. This makes it simple for everyone, regardless of their account size, to trade along with us and enjoy our 94% average trade win rate. So if you'd like to increase your trade account's balance, I suggest you sign up for our option trade alerts at theempiricalcollective.com.